All right, we finished off last week with a bout of volatility with this coronavirus and what could happen over the weekend. And while things continue to be a little scary from that perspective, not enough to keep that volatility going as the market settled down today. And the question now is, have we settled down? Have we had enough of a pullback to really qualify this as a breather? Or are there signs or signals that suggest there may be more to come? And so I'm going to talk about both of that for you so you can kind of decide on your own, and I'll give you an idea of what I'm thinking and how I trade that. And we'll take a look at one way to do that with our trade idea of the day in one particularly weaker sector. So let's go ahead and get started. Today is Monday, February the 3rd, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see a little bit of a Harami pattern here today. We still have the yellow line, light pink shading. Remember how that's a bullish pattern normally. It's just a concern when we're 4 months in, especially when the Russell 2000 is already, this is the transition I actually expect the S&P to have, going from light pink to dark pink, yellow line to red line. Obviously, we need to go down more for that to happen, because if you notice, the NASDAQ hasn't even got the yellow line, and we're actually back to, we don't even have light pink shading anymore. So, and those are those big tech names that are kind of dominating the broad market. Here's the Dow, where we do have the dark pink shading, and we are far enough below the 30-day moving average that red line, that green line is kind of fluctuating now, and it will most likely turn dark green. So the question is, when is that intermediate pullback going to really take place? And that's going to be when we start trading below Friday's close. We get below this 23% level, then you got this pink area of support, which is the Fibonacci retracement zone. That's going to be your pink area of support there. You'll see here in a minute, there's an opportunity that we can come all the way down to this 50% retracement of this run. Really, actually a pretty decent chance that we can come down there. So we'll keep our eyes on that. I think the more likely scenario is we come down to the top end of that area, to the 38%, maybe a little bit below towards 3,100. So we'll kind of keep our eyes on that. But you can see, and we don't have the strong bearish trend yet. The market sentiment's still above 80. So we are just in a pullback, right? We're not like, as bearish as things may seem, we're not falling off a cliff here anytime soon. And even the Russell 2000, which obviously is more bearish, you can see fell down. It got through the 23, so we started the intermediate retracement pullback when the intermediate line gets below 50. But it hit the top end of this retracement zone. That will act as a support level, the 38 to 62% zone. And the 50% you can see lines up with a lot of old highs here. So the Russell 2000 is showing what most likely will occur in a lot of these other indexes as soon as these tech stocks probably get to their earnings and they get caught up in the wave of the momentum of this intermediate selling to the downside. Again, not that I think this market's going to go down, but a move down towards 3153, which would be about 5% off that high, would be very, very healthy. And it's very seasonal. This is the time of year we tend to be bearish anyway, because if you recall on the seasonality chart here, and then change this to show prices percentage and go back as far as I can, you can see this is the time of year that we are pretty bearish, all the way up to about February expiration, in this case February the 10th. So we still have a few more, about a week potentially of bearishness. Now we went below it, so we might bounce up a little bit more here, and that week of bearishness might be postponed until the following week, right? Until we get towards that February expiration date, right, into this area. This is kind of the area where I actually expect that will probably bottom out. So whether or not we just go sideways for a while and hold this one, or whether or not we pull down further, which is what I expect actually will happen, because it already has on the Russell, right? So I expect we'll probably come into this area, if not a little bit below that, into this area here where this bottom line, the 62%, crosses, and it might be a little bit further. It might take a little bit longer to figure out that low point. And there's a good chance that can happen, as you'll see here in just a second. If you take a look at its Ichimoku cloud, you see now we don't have a strong trend anymore. So with Friday's move and then today's move, we've lost that strong trend. It's gone. It's hard to get it back. So this is where the intermediate pullbacks come in. You notice we don't come down and go right back up. So we are in the midst of, according to this, we are in the midst of a pullback. That's kind of the nature of the beast. When you look at it, the Bollinger Bands, there's that same Fibonacci retracement zone. Here's this volume node, and breaking through this node puts it into this Fibonacci retracement zone, right into that 50% area where the next node happens to be. So lots of indicators kind of suggesting that we are in the midst of a pullback. The negative has crossed up above 25, already had, but today the positive index finally crossed below 20. With the ADX already above 25, suggests that we can still get decent moves. But that's the pattern. That's the bearish pattern there. I mentioned in a tweet today that here when you, we'll take a look at that. We'll look at the Arun indicator here in just a second. Before we look at those other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That will notify you when these videos are posted. Hit the thumbs up icon down below the video. That will tell us that you liked our videos and that you want us to do it again tomorrow. So a quick way to give us feedback. If you don't like our videos, you don't have to click on anything. Also, while you're down there, comment. What did you get out of it? What do you like? What do you not like about our videos? Let's keep the conversation going in the comment section. Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link. It will take you to where you can subscribe to our site for free. Follow me on Twitter for more content in between these videos from day to day. And join our Market Outlook Facebook group that we've created. Also, if you're watching this on our blog, I invite you to check some of these things out. We have been making some trades on some of these older Market Outlook trades that we put on. We've been managing some of them. So make sure you check us out to see what we're doing with them. I do that. I let everybody know in the Market Outlook live videos. We also have already put on today's trade idea before the market closed. We did it too. These are always done at 3:30 Eastern time. This click on that image. It will take you to that page. It's also right here. The Market Outlook Live Trade Review. Also, our February calendar is up. So remember, our monthly subscribers, not only do you get access to the Market Outlook Live video, our Plus subscribers, which is, you can see right here, our Plus subscribers, they get access. You get access not only to our Market Outlook Live videos, but all of our trading rooms. Our premium subscribers get access to the Q&A sessions as well. But all the other 8 trading rooms that are listed here, you get access to with our Plus, our monthly subscription. So click on that link there, check it out. Like I said, the Market Outlook Live is one of our most commonly requested things. People wanted to see, what do we do with these trades once we put them on, which makes sense, right? I mean, you watch a show like, Halftime Report, they'll tell you about this stock or that stock, and they'll talk about a trade, but they don't get very specific about managing or risk management in terms of how big a position should be, and they don't talk about it as it's going. And we do that in all of our classes, and I give you a taste of that with these Market Outlook trade ideas. All right, so back to the charts, and let's take a look at the long-term chart. And you can see, last week was a bearish transition candle. We just went straight from bullish to bearish, skipped a little intermediate because we weren't that bearish, right? We didn't get that big, and it's not looking like we'll get that big either this week unless we break below 32.14, which is the 23% retracement level. So that's why I think, we can come down here, and by the time we hit the 50, we'll probably fill in that gap up to the 200-day moving average because it will have risen by then. But I wouldn't be surprised if we didn't do that. Otherwise, just kind of watch for a brief little dip, something like this, where we get a good amount below the 50, where we test that 30-day, but only on a low basis like this. Nothing too significant, but significant enough to give us a low point that we can bounce off of for another 4 to 13 weeks, probably like 8 to 13 weeks afterwards. Get a good intermediate, multi-month intermediate run out of this. Probably by the time we get to this week, which is the week after. That February the 10th, kind of what I was telling you about the seasonality. So probably right by here, and then we start to transition and work our way back up until the beginning of May, which is a very seasonally bullish time of year. Now, whether or not that ends up being the case, obviously depends upon the headlines and what's driving this the volatility right now. But from a pure technical perspective, that would be the expectation unless we see something different. Until we see something different. Let's take a look at the 3 green arrow chart. You notice we got a little green arrow today, so the stochastics turned up before getting into the reversal zone. So I actually think that will be temporary. We'll see. You can see how bearish the MACD is down here. We're still, the histogram members measures this gap between the blue and the orange lines. The blue is just crossed below zero. I expect that will continue to go below zero as the 8 and the 17 day finally eventually cross below the 30-day moving average, like it's already done on the S&P, or excuse me, the Russell 2000. And you can see the stochastics turned up, but it's still easily below its moving average, which is below the chart's midpoint. See, 0 is the chart's midpoint here, and we're not, the orange line's not below it yet, but the stochastics moving average is below it. So you can see how we're getting progressively bearish here on an intermediate basis. All right, now let's take a look at the the short-term charts here, the 4-week chart right there. This is something I brought up on Twitter too. So this is what I wanted to tell you. The low tag is over here on the left, and eventually, if we flirt with this low point, because yesterday, I mean, that's going to be the new low point once this is done. 320.36, and over here the low was 320. What was it? 320.73. So we'll bump up a little bit, but that will be the new low point. So the low tag will be on the right of the high tag, and what that means is from an Arun indicator. And it will be like, it will be within a few days. So that means the red line is going to cross up above 75. That doesn't always lead to a, you can see like right there, it didn't quite lead to a intermediate pullback. But all these other times where it did get to like 100% on all of these, like if we do get a new intermediate, a 4-week low point, all of those times, this one didn't as either, but all the times where we did get to 100%, it was in conjunction with an intermediate pullback. So kind of keep our eyes on, that 4-week range and testing yesterday's low, which will be the 4-week low here after a couple of days. Are we going to get a new low point below that? If we break down below that low point, then we will have that Arun indicator will get, the red line will get to 100. And like I said, that's another sign of a that's another sign of an intermediate pullback, and again, that's a common gap. So I expect that gap will be filled. It might not be tomorrow. It might take a day or two. It might be tomorrow morning, right? But I expect that gap will fill here, just like all these other common gaps have been filled in. If you take a look at today's volume and trading range, the volume hit 69 million, so a little bit above average. The trading range was close to average by itself, but remember we had a gap. We had about a 1.5 gap from 321.73 where we closed Friday to today's low of 323.22. So you add a 1.5 onto that, and now we're looking at about 4.5 points versus just over 3. So put that in the context here. That's a pretty strong. That's going to keep moving this up, and then you also see too that we're getting ranges over 3.25 points. That's 1%. Right, again, another sign of an intermediate pullback is once this thing crosses above. And another tweet I ended up putting out today is during intermediate pullbacks, you end up getting 1% drops. They usually mark the beginning of intermediate pullbacks, but you also have 1% gains, right? So for those of you who don't follow me on Twitter, let me just show you something here really quick. So here's those tweets I was talking about. There's the Arun indicator I was telling you, and here's the idea that the 1% during intermediate pullbacks we have 1% drops and 1% gains. And today was pretty close. This morning when I tweeted it out, we were above 1% on the gains. We ended up not quite getting 1% here. We ended up with like 0.75%, but still we are above the 0.5% mark. So which obviously you can see where. You have big moves to the upside and the downside during the intermediate pullback. So I think that that's the case here, that we had a big move to the upside, and I really don't see us the intermediate trend halting until we get this blue line to come up closer to the purple. You can see usually by the time we bottom out, the blue line is either crossed up above or is right at the purple line, like in some of these other cases here. That's the sign usually that the intermediate pullback has stopped, and one of the signs that it stopped. And you can see I don't think we've stopped yet on this particular drop. Finally, the volatility index is another one of those signs, right? You get up above this 1% mark. You have to break back below 90% for the intermediate pullback to be done, and for us to really get going back to the upside. And that hasn't. Now, granted, we really haven't significantly started the intermediate pullback except for on the small cap index because of how strong the NASDAQ has been. So we're still kind of in, I mean, it's a process. Somebody tweeted at me the other day about, how can how can this already be over? It's like, nope, the intermediate pullback's not a one-day event. It's a process. It's going to be a process of ups and downs. There's going to be a process where we think like the world's going to end. There are days during the process where we think the world's going to end. There's going to be days like today where we think like, okay, we got this. It's bouncing back up. We're done. Here we go. And the reality is we still got some work to do, to exhale, to get, to get rid of some of the short-term excesses that we had so we can build a better foundation and base to bounce off of and get another good multi-month run out of it. So I think we're still in that process. In fact, we're actually still kind of in the early stages of that process. All right, so what do you think? Do you agree with that assessment? Do you disagree? There's a link popping out right the top right corner of your screen. Click on that link. It opens up a poll. Then hit either agree or disagree. If you click disagree, if you're either more bullish or more bearish than I am, comment down below and share why. Like, what are you looking at? Obviously, everybody's got their opinions, but what's driving your opinion? What are you looking at? And let's share that with our Market Scholars community down below. All right, now let's talk about what's driving price action here. And we'll take a look at the last 2 weeks and see the safety trade is just really going full bore. You have long-term bonds, foreign bonds in green, gold is up, the dollar is up. Investment grade, high yield bonds, investment grade is outpacing high yield bonds. The S&P is outpacing the IWM, small cap index. EFA is outpacing EEM. Gold is outpacing crude oil. Treasuries are outpacing corporates. I mean, it's about every single risk-off relationship there is, we're getting right now. If you take a look at just today alone, so let me move this over to just today alone here, and let's go like to a 5-minute chart on this. Then you can see we started the day actually pretty strong. Emerging markets, small cap stocks, U.S. stocks all up, along with real estate and the dollar. Interesting to see. It's not often you see emerging markets and the dollar both up today. If I were to move this over here, you can see there's EEM, there's IWM, mid-cap stocks. Pretty decent day from that perspective. If you look at the different markets that are involved, and you can see South Korea was up there, there's Taiwan, and then China had a good day. On the other end of the spectrum, India, Thailand, on the other end, of course, the UK with the Brexit impacting them. You can see gold was down, bonds were down. I mean, it was pretty much a risk-on day, but not the most. I mean, the dollar was up today, and that's not your typical risk-on relationship. In fact, if you take a look at the chart of the dollar itself, I mean, that's a pretty good bounce off of that light pink shading and yellow line pattern, which is really bullish when you're at the beginning of an intermediate run, which it looks like we might be with that cluster kind of confirming. So as much as I'm not very bullish on the dollar in the long term, it's got a pretty good intermediate pattern developing here. The beginning, an intermediate run developing here. And that's, it doesn't necessarily mean that we have to be bearish, because you notice it had a pretty good run here. And if I were to put on a comparison chart with SPX, so you can see how the S&P did during that time frame. Once we really started to take off, and this intermediate run really started in this area and took off, you can see the stock market didn't do so well. And then, but over here, where we had a really good run and a few little pullbacks, but we had a really good run in the dollar. We did well for a while, but by the time the dollar move was at its peak, the intermediate run was over, we were pretty flat because we had gone up and come down. So it's not really a good thing for the stock market to have the dollar in the intermediate run. You can see when it's on a bearish run, intermediate run, with dark pink shadings and red lines, you can see how bullish the market can get. Same thing over here. When we were on this bearish run, how bullish the market got before it peaked when the bullish intermediate run started. So as much as I don't think that we'll have a good bullish run all year long on the dollar, the pattern is setting up really nicely right now for a bullish move on the dollar for however long. And again, that would line up with some volatility, typically with some volatility in the markets. Would also line up with bearishness in the commodities like crude oil, which is really struggling. It's getting cluster after cluster, and it had another cluster here today. This is actually the overnight session that's just barely starting. But look how bearish, or look how far below. In fact, if I were to go to the PPO chart here and look at crude oil itself, you can see, it's a pretty bearish chart, and we're closing on the Hakinyashi level below this line. That's the important line we talked about last week. So we'll see how we end up this week. If we end up with a lower shadow like this, that's okay. If we end up closing below it, not so okay. If I were to change this PPO pattern though to just a daily chart, and then let's look at the PPO here on this basis. With today, how far away we are, how far below the 30-day moving average we are. So I'll just bump this down to the 30-day moving average, and you can see again, if I were to kind of give you some context on this, and disregard the choppiness on the lines up here, but we're more than 10% below the 30-day moving average. And the last time we were this, we were in the Q4 of 2018 was extremely bearish. Right, we were, this is a very similar period to this period over here in May and early June, where crude oil really dropped pretty sharply, and we kind of found some support in this area. So now the question is, are we going to find some support in this area again on crude with OPEC meeting? I mean, look at that chart there. It's very little more. The volume, we're in path of least resistance on the volume. If I were to jump this out to a 5-year chart, you can see where right in that 78% is right where the right about $49 is where the point of control is. So there's some significant support in this area. We'd have to really kind of break down here for us to get bearish like we were, even for that matter in Q4, to have that significant of a move on crude. And if I were to go back to that PPO chart again, then switch to that daily chart. Here we go, switch to the daily chart, and then change the PPO to how far away we are from the 30-day moving average like I showed you before. And then this time, instead of showing crude oil, let's see, let me bring up crude oil. Instead of showing crude oil and how bearish it is, I want to compare TNX, which is another sign of inflation expectations. Look how low it's gotten. So, and that's, these low points kind of marks, these significant drops kind of mark some short-term oversold levels. So while we can keep going down, and I've mentioned before this concept of TNX forming a divergent low point below, maybe at 1.25%, very similar to what we saw here. That concept's still out there, like this one right here, forming the higher low point after getting a significant low there. I do think eventually we'll move back up again, and so with a bullish dollar, if we do get an intermediate run on the dollar here for a while, going into February expiration, maybe a little bit longer, then I would expect this to form that divergent low point. I would expect crude oil to figure out what it's this support and maybe even go down a little bit further towards 49, towards that 5-year point of control where there is that significant layer of support there. So some more bearishness potentially involved from an inter-market relationship, not just U.S. equities. If I were to take a look at the foreign markets, all of them here, to kind of give an idea right here. If I were to look at all the foreign markets here, you can see we got dark pink and red lines all across the board. So this is a broad sell-off that we're just kind of starting here in the U.S. Everything else has been pretty bearish. I mean, to the point of some oversold clusters in Germany and the UK, but we're pretty sharply below. So that's I don't think necessarily that we're done yet here on this selling. I think that we're going to also turn into what we're seeing here with the dark pink shading and the red lines. Now let's take a look at the sectors, and we'll do the kind of the same thing with the 12 grid on the U.S. sectors. And you can see some are still, hanging in there. Look at technology, easily above. It's no light pink shading there, and no. Because you can see we're below 80, but we're rising. No light pink shading, no yellow line. A little bit of light green shading on the discretionary index because we are below 50 here. We got some dark pink shading in some of these other areas: energy, healthcare, industrials, financials. We have light green shading, but we're still got the red line. So you can see how bearish we are in some areas that have been really bullish previously. Where's that healthcare sector right here? So healthcare and industrials and healthcare and financials especially, technology holding up. Discretionary have been lagging, so it's just kind of starting to catch up. to some of these areas. And of course, energy and materials are dollar sensitive, so they're going to struggle with strength in the dollar. We've already talked about the weakness in crude oil really impacting energy, and you can see the strength in the safety trade. Dark green shading, red line, light pink shading, or excuse me, green line, light pink shading but still green line, light pink shading but still green line. So that's where the strength is right now, and that just kind of suggests another sign that we are in this intermediate pullback. If you look at the comparison chart of the last 3 months, you know, there's some gains in these cyclical areas to give up. There's some weakness in these safety trades to gain, and they have been. And if we look here at the 2-week chart again, like we did before, so let's see, it'd be 1 to the 21st. Sorry, not that one. Right there, and then we'll go to a 10-minute chart. So here's that 2-week, and look at utilities really doing well. The only one that's up, real estate, staples, but look at discretionary and staples, consumer stocks both outperforming, and technology still outperforming to the upside, whereas energy is down 11% in the last 2 weeks. Healthcare is giving back some gains. That's not surprising. Materials is also down with energy. That's not surprising with the strength in the dollar. Communication services, it's been a strong sector with some of these FANG type stocks. It's giving back some recent gains. And then there's, of course, there's financials and industrials, other cyclical areas. So very typical pattern that I don't think we've seen necessarily the end of yet. Now, that doesn't necessarily mean that I'm bearish, right? I'm still got a pretty bullish active trading portfolio, as most of market scholars who attend our trading rooms can attest. But I'm not as bullish as I've been, and we've been adding progressively some more bearish trades at the end of last week. We did a whole technical analysis class on identifying hedging opportunities if we were to continue this intermediate pullback. But you can't hedge something that you don't have. So, because if you put on a hedge without something to hedge, then you're bearish. I'm still bullish. I still think long term we're bullish. I think that in the intermediate term we're pulling back right now, and we can take advantage, especially in a sector like healthcare, like we did on Friday. For those of you who have the Telegram, I sent out I didn't do the Market Outlook live because I was out of town, but I did send out the Telegram with Friday's Market Outlook trade idea, which was on Humana. Today's trade idea is going to be on another healthcare area, and that is United Healthcare. Very similar to what we see with Humana, a little different pattern. That's a very strongly bearish pattern, dark pink shading, red line, the intermediate posture strongly bearish. The difference between Humana and UNH, though, is UNH is, we've been walking this tightrope way up above the ground, and we've got some room to go to the ground. We've covered a lot of it already, so it's kind of hard to be too directional here because we've covered so much. If you take a look at the long-term chart for UNH, there's still a gap in the fill, but we're pretty close to the 200-day moving average, and that's about as much as I was expected to go down, if it does go down. So with that being said, I want to be bearish, but I don't want to. You can see all the other charts are all bearish. If you look at its 3 red arrows and the red line, you look at its DMI, you can see a bearish pattern on CMI with ADX already up above 25. You look at its trend strength indicators, the Ichimoku cloud. We are trading inside the cloud, so it gives some room to be bearish here with a moderately strong bearish trend now. So, so there's a lot of bearish signs, and we can take advantage of that by saying, okay, well, if I sell the 290 call, which is right around that 31 delta, and buy the 300 call, and try to get, it's a pretty expensive option, and the spreads are wide right now. They weren't as wide when we did this during the Market Outlook live session. But if I did that trade there, and you can see we eventually got filled in for 237, but that gives me about 3/4 of a normal position. If my normal position risk is about $1,000, then just doing one contract, because it's $10 wide, gives me, 232 is 30%. So we're just a little bit above 30%, which is exactly what we want, a relatively high probability trade. And you can see that's the blue line that we have to cross back up above in order to take a loss. So it's got some room that we can go up, and even to the top, to the bottom of that gap there, that will act as a pretty significant resistance. You can look at, again, the Bollinger Bands for UNH, and even just looking at here on the 4-week basis, or kind of a shorter term basis, There's that 290 area. That's where the short strike is. So we'd have to fill in and get through that point of control now, which will act as a significant resistance in the short term. It also happens to be the midpoint of the chart, and will be, unless we get a new low, will be the midpoint for a while, because the high is not going to go anywhere anytime soon. So you've got some pretty decent resistance that will hold and keep those options out of the money, which is what you want when you do that short call vertical like that. All right, well, that does this for tonight. Again, thank you very much for watching. You've heard from me now. Now I want to hear from you. Use that link right there popping out in the top right corner of your screen. It takes you to our forums. Open up any new thread, and let's keep this conversation going. Obviously, you can reply to other people's threads too, but I want to get some interaction on what you're seeing and what's going on in the markets. We've been getting more views, which is very typical when the markets get a little bit more volatile. So that's great, but let's keep this conversation going in between the videos. Again, thank you for watching. Hit that thumbs up icon, comment on our video, and subscribe to our YouTube channel. Follow me on Twitter for more content in between the videos like I showed you before, and join our Market Outlook Facebook group as well as our website at marketscholars.com. Have a great rest of your Monday evening, everybody, and we'll see you all next time.